Welcome to Beyond Tomorrow, a conversation purpose to motivate your disciplines of today in response to your goals beyond tomorrow. I'm Andrew Nida, sitting with my co-host, Moise Param. My man, how are you?
What's up, brother? I'm good. I'm doing good. I'm pumped up today.
You're pumped up because you got to experience something this past weekend that many people don't get to experience.
Yes. It was definitely one of those moments up there in my life that I will always remember. We were able to, my family, my wife, your kids, and Olivia, we all went to go see the Trump rally in Rome, Georgia, right in our backyard, and it was absolutely amazing. You know, the opportunity to go see a former president speak and deliver an amazing speech at the same time, and just being around that environment. This is this time in history right now is a very, very crucial time, and just to spend an afternoon around.
Yeah, it's pretty cool.
Just seeing. I've never seen a former president before.
Yeah, it's pretty cool. And just to give you guys the full experience here, I mean, Mo, Amy, Amber, Drew, Olivia, like you guys just didn't get to go. You guys showed up. They told you that it was at capacity and
That's
that
right.
no one else was getting in. You were prepared to sit outside.
Yep.
Okay. And when it's all said and done, you're 3 rows back, dead center stage. Okay. You could imagine I'm sitting there watching the news, and literally I can see my son. I'm like, so I call Amy and I'm like, babe, you got to stand up, turn around, so I can screenshot the television. And so sure enough, she stands up. She's on the phone. You guys are all standing there. Everybody's waving. I'm like, man, this is a pretty cool experience.
Yeah, it was awesome.
That's awesome.
You missed out.
Well, I missed out because I had work to do. Thanks, Mo. No, it's springtime, right? Summer, not really springtime. What am I talking about? It's close to springtime.
Preparing for spring,
Yeah,
basically.
Yeah, and I had yard work to do.
Yeah.
But that's okay. No complaints.
Well, that'll be my weekend this weekend.
Well, so you and I are starting a 4-week series on real estate.
Yes.
And, we don't want to really cut the week short. So before we get there, you want to hit just kind of a few highlights. The one that kind of comes to mind from a market standpoint just from this past week is the S&P 500 literally, Mo, 17 out of the past 19 weeks have been positive.
That's amazing.
Yeah, just to give you
amazing.
Guys a reference point, we're talking literally since 1964. Okay, you heard me right on that. 1964, 60 years. Okay, since we've seen a trend like that. That's pretty powerful.
Yeah, it is pretty powerful. The market has just been on a tear. The momentum has been going since we saw October lows last year, and it's just been on fire since then. Spearheaded by IT, information technology. We're starting to see comm services starting to pick up as well. We're seeing small caps and everything of that sort. So the breadth of the market is really starting to expand. And 17 out of the last 19 weeks for the S&P to have a positive return. This is why, as an advisor, we say you have to stay invested. You have to have a disciplined approach when it comes to investing. You can't try to time the market. And 17 of the last 19 weeks. That's amazing.
It really is incredible.
I love it.
And you're right, but you got to have a process that you can believe in too.
That's
a
true.
lot of investors don't have that. Another one, the longest stretch of unemployment less than 4% since Nixon's first year in office.
Since Nixon.
1969, I believe.
Okay.
Like, is that not absurd?
That is absurd.
Yeah,
that
unemployment rate's significantly low, which, is evidence that we're sitting in an economy. And I know there's a lot of rhetoric and a lot of noise out there surrounding the viability of our economy and government debt that's just at absurd levels. But the reality is companies are continuing to do well and people are continuing to benefit from that. And unemployment is, once again, we're talking lower than 4%, which is, on a stretch for a history-breaking record.
Yeah, unemployment below 4%. It puts a lot of pressure. I'd say on the Fed's decision to cut rates. If unemployment continues to stay low, we still see some positive news and and companies continue to evolve and innovate, and the consumers continue to continue to spend, and then I really just see this whole idea of longer, higher for longer continuing to be there.
Yeah, right. I think you're 100% correct.
Yeah, I think when the rates started to increase, there were talks about we need to get unemployment up to almost close to 5%,
maybe over 5,
and we've been hovering well below 4 for over a year and a half now, almost 2 years now. So, I love it, right? I mean, we definitely don't want to see more people unemployed. But yeah,
you want to see people be able to thrive,
right.
In an economy like this, and it seems like a lot of people are. Now, it's not saying that's true for every area and every region, but there's definitely a lot of good that we've witnessed and experienced. Also, as we've seen, what's going to be a later topic: real estate values grow and our portfolios grow, and it's just these companies have done quite nicely. And another thing that's done well is Bitcoin.
I knew you were going to go there. I knew you were going to go there.
1.3 trillion, Mo. If it was a publicly traded company, it would be the 8th largest company in the world.
That's insane.
That's absurd.
That's insane.
Okay. And so, it's like up 300% from its lows of 2022. I think BlackRock put out a note that they are looking to incorporate it into their strategy for income, which I'm a little bit confused on how that's actually going to work. But nonetheless, it's just proving and providing evidence that this is something that's going to be relative and playing a part of our, currency at some point in the future. It's pretty interesting.
Yeah, the innovation of the spot Bitcoin ETFs has just made it a little more relevant and it gives it a little more staying power, I would say. Mm-hmm. It's still one of those speculative asset classes that any investor who wants to get into it really has to, be cautious, because we've seen the volatility and the fluctuations of Bitcoin or just cryptocurrency overall over the last few years. But it's one of those things, again, that over since 2022, you said 300% return. And actually, the other day when Bitcoin hit its all-time high, gold hit its all-time high the same day.
The same day.
Can you believe that?
That is crazy. Which gold's been ripping. It's been, for sure. It is interesting.
It's a wild market.
Yeah, I'm anxious to see. This year's going to be fun to work through, and obviously, to manage clients' assets like we do. It's going to be a good year.
It's going to have a good first quarter review for our clients.
That's exactly right. All right, you ready to jump into the topic?
Yeah, I'm ready.
Okay, so I want to start with a statement that I'm just going to read it because this is a great article. You guys should definitely consider reading this article. It's from Scott Galloway, who is coming out with a book, The Algebra of Wealth. He has, I cannot remember. Oh, this is not good. And I'm going to reference it. Malice. We'll have to look it up. Okay. But I want to reference his website, because it's a great one. So I'll tell you what, next week I'll definitely put his website out there so you guys can navigate to it and see it. But anyway, he put out basically some little snippets from his book. Okay, Mo?
Okay.
And this is what he said. I know a lot of people who make an extraordinary amount of money, but few people who are rich. Rich is having passive income greater than your burn. People on a path to money focus on their earnings. People on a path to financial freedom also focus on their burn rate. Okay? Now, that's incredible because he is 100% correct. We are continuously telling our clients that your ability to retire is contingent on not just how much money you have, but the pressure point between how much money you need and how much money you have. There lies your ability to not only retire, but Lord willing, stay retired, okay? Or stay financially free.
Right.
And so he's talking about, listen, you can't focus on one component and not the other, okay? You got to focus on both. And so when you look at your burn rate, if your burn rate is too high, who cares how much money you have?
Yeah.
Right? And so he's making a good point. And then I want to read the second. Billions of dollars are spent every year on schemes to manipulate our natural impulses into spending more money, consuming more fat, and believing everyone around us is more successful than we are.
That's so true.
Upgrade from economy to... No, hold on. Oh, I missed that last one. Okay. The most powerful forward-looking indicator of your financial freedom is not how much you earn, but how much you save.
That is so true.
So the whole idea, and the reason we're bringing this statement up in this article as we start a 4-week series on real estate, is because real estate predominantly, I know it's not in every situation. We're going to talk about a wide range of different real estate entry points, but real estate predominantly is a cash flow producing king. Okay? So when we're talking about burn rate, we're talking about cash flow, we're talking about your ability to retire, stay financially free, we got to talk a little bit about real estate.
Yeah, you have to. You have to, because, real estate is one of those, it's a hot topic. It's been a hot topic for a long time, but it's one of those assets that adds a lot of layers and multiple layers of diversification within your portfolio. First of all, it's a tangible asset, right? I mean, it's not a stock. There's no longer stock certificates being issued right now, right? So, it's not a series of ones and zeros on your computer. It's an actual asset that you can walk into, you can touch, you can feel it. And over time, the appreciation of real estate has outsurpassed the S&P 500. I think it's from 2000 to 22
to 2022.
To 2022, right? As a whole, real estate has outperformed the S&P 500. So, as an asset class, real estate does add a lot of layers and diversification inside your portfolio. And so, one of the main questions people ask is, why should I get into real estate? And also, is this really a good time for real estate? Mm-hmm. And I would say should I get into real estate? Well, it adds a layer of security. People need a place to live, right? You need a place to live. You need a place to store assets. Right? Storage units are really big nowadays, especially here in Northwest Georgia. You need a place to house now in this world right now. Data storage is a huge business right now. And think about it. We're going on vacation. We're going to the Florida Keys in a few weeks. We need a place to stay.
A tiny home that costs way too much money. Yeah, that's where you need to watch your burn rate when you're renting a tiny home. Price per square footage.
You got to think about that.
That's the best price to rent, hands down.
But yeah, so real estate again adds all those layers within an investment that other investments just don't do.
No, I think you're 100% correct, and there's a lot of value that comes with being able to see the investment, right? I think there's a lot of investors out there that stay away, and they shouldn't, okay, but they stay away from market-based investing and shift toward real estate because of the comfort of saying, hey, man, I can touch it, I can feel it, I can see it, and I can see the transaction, the revenue stream coming in. So for that reason, it's just not numbers on a screen. It's just not numbers when I log into my dashboard, online at Schwab, Fidelity, Vanguard, whoever. I like the security of this type of investment. But to your point, people got to have a place to live. When you look at the national numbers, I think it's 43 or 44 million individuals are renting their house.
Wow.
Okay, so that's a huge number. So we know that the demand is there for residential rental. And, people like to vacate. Me and you, we said that. So it's just, or why do people do it? Because it's a secure investment. The other thing that I would say is it's a potential investment that allows you to win in two different ways. Okay, you got the cash flow attribute, and then you still have the equity appreciation in the price. The price of the property. Okay,
sounds like a dividend stock to me.
It does. Except a dividend stock typically doesn't grow at the equity value increase that we've seen in real estate over the past 10 years. So there's definitely those two areas of why you would invest in a property. Now, what we're going to do in today's podcast is basically break down some generalities around investing in real estate. Okay. Mm-hmm. The upcoming weeks, we're going to talk about short-term rental. We're going to talk about long-term rental. We're going to talk about house flipping, if you will, and how to quantify those deals. But this week, let's just talk in general, Mo, about, why real estate, we said it. So on to the next one is this a good time? How does an investor, man, in this season, accept the price of the property, knowing that it's priced at levels that really we haven't ever seen before? Mm-hmm. Okay, everybody can go on to GIS, your government tax maps for your local county. You can pull up the transactions and the purchase prices for these properties years in the past. And when you do that, it's uncomfortable when you're about to buy a house. You're like, man, I am buying this house at like literally 3x what they paid for it 5 years ago.
Right.
How does an investor get comfortable there? And can they really believe that now's a decent time to buy?
You know, I'm not a real estate guru, right? So, you know, I want to definitely say that up front. But what you want to do is really just look at the opportunity that's in front of you. Real estate, again, as I mentioned before, real estate has appreciated well beyond the overall S&P 500, this broad stock market over time. So with that as the baseline, you would expect to pay more for an asset that's growing at an accelerated rate. That's one thing you need to accept, the fact that happened. If you just look historically, right? I mean, you know, you look at the properties that 2008 to now. I mean, home values have just gone up over time. We're in a very low interest rate environment now. Rates have gone up, and so the demand and the frenzy when that period of such a low interest rate was there, we just saw the value of properties go up. So the question you ask yourself is, do you want to try to time the real estate market and say, well, I'm just going to wait for this type of housing correction, and that could be a wait and a guess that you may get wrong.
Yeah.
And so by the time you may realize that rates aren't going back down. Well, rates are going down, but the prices aren't going back down. That same house that you're looking for is going to appreciate even more, and you may price yourself out that house at the same time. So to kind of wrap your head around it, you ask yourself, what's the end, in my opinion, I would say, what's the end goal of the property that you're looking to get into? Is it short-term? Is it long-term rentals? Or are you looking to buy and flip? Or is this a place that you want to, you know, see appreciation over time, and cash flow is not even a need for you? Because if you understand what your time frame is and what the end in mind is, then you can somewhat justify the overpricing, if you want to call it today, because your exit strategy for that property could be 10 years from now.
Yeah, that is exactly the talk.
That was a mouthful, but do you get
no,
what I'm saying?
I do, and it correlates with the whole concept of beyond tomorrow. You don't look at the investment today and say, okay, it feels good, it seems good, it might be good, let's roll the dice. No, you identify what the purpose is of that investment long term, and I think that's one of the most important decisions you can make, because that should correlate with your season of life and ultimately the financial plan that you're trying to deploy. Okay, right. As an individual. So, you know, it's different if you are, you know, late 30s, early 40s, looking to purchase a long-term rental versus 65, 70, investing in a long-term rental and you need cash flow tomorrow, right? It's a totally different outlook, and one investment might make sense for that person where the other one would not, depending on their season of life. So to your point, the very first thing you do is identify what is the end goal. Okay, I'm thinking down the road. I'm thinking this is what I need to support my financial plan and to become financially free if I'm not already. And these are the decisions I need to make today. Property is a great idea. And once you identify the type of real estate investment you're trying to accomplish, then we move into a little bit of the economics behind it.
All right.
Okay, and what we want to break down first, at least the way that you and I both approach real estate investing, and both of us have real estate, is we're looking at more of a macro outlook, okay? Starting there. A macro would be things like general population in the area, okay? Population growth, okay? We want to look back, pull the data, and say, okay, you know, since 2015 to 2020 to 2022, and unfortunately, local data is going to be a little bit outdated, but you're looking at, you know, the last 5 years, the last 10 years of population growth in a given area. You want that to support the concept of why I should buy this investment long term. Wage growth, okay, which is typically going to happen if population growth is there. You're going to see wage growth. Wage growth is going to support if jobs are there, if industries are moving into an area. You take an area like you and I both live in, Cartersville, Adairsville, this North Georgia corridor coming up 75, you're getting pressure from Atlanta, you know, outside of the perimeter. You're getting pressure from Chattanooga moving south, and you're getting a lot of new manufacturing, new industries, new warehouses. And you know, these mega companies, man, they're investing way ahead of growth. So they're moving into these territories. So you know, okay, Job growth is here. Wage growth is here. Population growth is here. And what do people have to have? They got to have a place to live.
That's right.
So all of the macroeconomics seem to make sense. That's kind of step one.
Yeah.
Don't you think?
Yeah, I think so, because that just makes it that for me that makes it seem like this overall community overall is a good place for me to buy. Right, because of everything you just mentioned before, right? Population looks pretty good. No one's moving out. We're going to meet more people moving in. Jobs are being created and wages are staying great. Income is going to support the rental. The rent that you're looking to charge. So that is a prime opportunity, at least the community itself. And then we look at the housing market in that community. So for instance, you want to look at the history of sales prices. I would look at list price versus sales price. Are we seeing fluctuations between the price that the house lists for and the price that the house sells for? Mm-hmm. Kind of gives you a gauge of the competition in the area. Look at how long the property's been on the listing. It kind of gives you an idea again of the attraction. If is there a demand in that area? You want to look at the average rent in the area. If you're looking to have a rental, then you see if the rent that you're thinking about is in line with what the rent is average in the community. Mm-hmm. So that kind of gives you some detail about just the housing market and the housing climate in that area.
Yeah, it kind of helps you get a good feel of that market. In the housing space. And I was thinking of one thing, which is also rent growth.
Rent growth.
Checking on to ensure that you're not just going to have an asset that becomes a dead asset. We're going to talk about how to quantify that, but how that property generates revenue consistently and increases to keep up with inflation. So there's a lot of that, and you're kind of starting wide if you can get the visual macro, and you're moving down, and all of a sudden you say to yourself, okay, all these data points make sense, right? Population's supporting the concept. Jobs, the location, the geographical area supports the concept. I found a property now. So now the property that I'm looking at has to meet also some type of criteria to ensure that it's going to make sense for my portfolio. Okay. So then we're moving into the math behind it. Okay. We're starting to quantify it. And, one of the basics ones is like the 1% rule as an example.
Yeah, the 1% rule. It basically means that a rental property should at least be generating 1% of rent for the price point that you've purchased, for the purchase price of the home. So if you purchased a home for $200,000, then 1% of that is what, $2,000. Mm-hmm. So you should at least be getting $2,000 of monthly rent for that property.
Yeah.
For it to make sense.
That's just kind of a quick, turnkey, simple way.
Yeah.
Yeah. There's also like a 5% rule out there, but some of the things that we use is cash on cash return,
like that,
and return on equity, or two of the. Return on equity is Warren Buffett's preferred way of measuring an investment. Now, specifically, he's talking about dividend investing, but we use it for real estate as well. So, cash on cash return is a great way of analyzing the initial ability for that property to create cash flow for yourself. Okay, and it also really speaks to the value of leverage. So cash on cash return is simply how much money do I have invested in this property divided by how much revenue this property will create. Okay, take a $200,000 investment. And in that $200,000 investment, I put $50,000 into it as a deposit, including potential rehab or any other type of capital asset or capital investment. Okay. So I've got $50,000 in this property. My cash on cash return is the net income divided by the $50,000 that I have in the property. Okay. And that determines my cash on cash return. And cash on cash return is a great starting point to just say, okay, am I in the ballpark? Mm-hmm. In the ballpark typically is what, 8 to 10% nationally.
Yeah.
Which granted, a 10% is a healthy target for a cash on cash return. Is it probable or applicable right out of the gate? In today's market, it's going to be a little tougher to get there.
Right.
But you can get there.
Yeah.
Okay. I've recently purchased a few properties, and it's possible to get to that number, but you definitely got to find the right deal for you. But cash on cash return, the reason I mention leverage, Mo, is because, sometimes paying cash for the property is not the best thing to do. Okay? You take the same scenario of $12,000 of rental income over 12 months on a $50,000 cash in investment, my deposit, versus that same $12,000 of rent rate against a $200,000 paid for home. Well, now that $200,000 is generating as a percentage a lot less cash on cash return.
Right.
Versus the $50,000. And remember, one of the benefits of real estate investing is the ability to leverage the bank's money. Okay. Second to that, return on equity.
Yes.
Return on equity is a great way to analyze whether or not you have a dead asset, because it speaks to things like, its ability to produce cash flow, but also your equity stake.
Yeah, is the property appreciating over time and forecasting over time? Is this an asset that's going to continue to appreciate and be a valuable source of the diversification that we're looking at in the first part? And also, is this property just going to be a solid source of an exit strategy for you, or is it time for you just to cut bait because it's just not producing? You're not really optimizing your equity in this property, and it could be better generated elsewhere. So that's where getting the return on equity in respects to the cash on cash return, both very important. Both measure two separate measures to see whether your property is successful or not.
Yeah. In equity, just so you guys know, to be just super clear, equity, the best way to look at it is if I sell this property today, what do I walk away with?
Yeah.
Okay. So in general, we talked about at the very beginning, there's a few reasons why you buy property. One of them is it produces cash flow, but the other is equity appreciation or price point appreciation. Okay. So which means that your equity position should always be growing. Okay.
Always.
And you need to take that into account. But the challenge, and to your point, Mo, if we have a dead asset, what happens if I own a house for, I got a $150,000 mortgage to my example, and I put $50,000 in it. The house is worth $200,000, but I've leveraged out $150,000, and I have $50,000 in it. Okay. Over time, what's happening? My mortgage is going down because I'm paying it off,
right,
and the equity is going up. Okay. Which means my return on equity, if my rent rate doesn't keep up, is getting less. Okay. Proving that I might need to pull equity and reinvest in a different property unless the rate can keep up to make it a considerable return on equity, which is 3 to 5%.
Yeah, that's what I was going to say. Yeah, 3 to 5. So that's why if someone says, is today a good time to invest? It all depends on the math. It all depends on what your expectations are. Have you done the due diligence to look and see, okay, what is my ultimate goal behind getting into real estate? Have I measured what is the right return on cash on cash return that I should be expecting? Can I forecast when I should be at a what I would call a sweet spot when it comes to a return on equity? And really, if you haven't really done that math, then we don't know whether this is an opportunity for you. But I would say, just generally speaking, there's an opportunity all the time.
There is.
You just got to find out whether it's the right opportunity for you.
Investors always find a way to invest.
That's right.
To end the show, I want to wrap it up with a quote. And don't forget, you guys, make sure you subscribe to our channel. Make sure you stay with us week to week as we continue to break down this 4-week part series on real estate investing. Next week being about short-term rentals. But I do want to leave you with a quote of the week, if you will, from Bill Gates. Most people overestimate what they can achieve in a year and underestimate what they can achieve in 10 years. Okay. Don't be that guy. Put in the disciplines of today. Stay consistent so that you can think about and live your dreams beyond tomorrow. Thank you guys for joining us. Mo, it's been a pleasure, my friend.
See you next week.
All right.